welcome back to another BMO video. Today we are going to be looking at employment and growth. Now you might have heard of this correlation before. Today is going to be a relatively quick video because it is a pretty simple concept to understand. And once you do understand it, you don't really forget it. So let's run straight through into it. So there is a positive linkage between stronger employment and stronger growth. And of course, vice versa, i.e. weaker employment tends to mean weaker growth. If you begin to see employment fall, this may suggest that in the future, growth will begin to fall. This will have implications on numerous data and will likely change the rhetoric of the market if they are currently in a strong growth environment. So kind of what we're seeing more recently, obviously I am recording this in November of 23. And we are starting to see growth pretty much everywhere start to fall, especially in the US. And I'm sure we all have seen already. If not, please go, if you're watching this sort of in 24 or even later than that, go back to sort of the price action around sort of November 2023. And you will see the markets have been selling dollars fairly aggressively because we started to see employment fall. And then what does that tend to mean? Less growth. And then think about the knock-on effect. Remember, in trading, you don't just think, growth is weak. Okay, that's it. It's about, okay, growth is weak. What does that mean next? So if growth is weak, think about it. If growth is weak, that means less inflation. That means rates are going to fall as a result. And as a result, the currency will likely fall. So this is the thought process. This is why the markets react positively or negative to the currency. Not because, just because the data is good, the markets have to buy the currency. So obviously understanding the underlying data, but then they have that knock-on effect of, okay, this happens here. What does this mean for this asset class, etc.? And then what does this have implications for this? Because they all interconnect, right? So it's important for you to understand all asset classes because that way you can have a much broader understanding as to what is driving the markets. Weaker employment could be an early sign that data will begin to slow. And this is when you can identify a shift in narrative for that economy. A prime example, what we've seen in the US over the last couple of weeks, where we've seen NFP show a downside surprise. Remember, think about the direction. The markets at the moment are trading the direction. The level is important, as you know from previous videos. The level is important. However, the markets do love to trade that direction because you can get in basically the tops of the trend and the bottoms of the trend and really ride that trade out. But yeah, as I was saying, it's identifying that shift is important. So the US is that key. NFP, we had wages coming slightly weaker than consensus. We've had a tick up in unemployment. We've had some weaker employment data within PMI data. Again, if you are a bit confused about the employment component or the components of PMIs, please watch the PMI video. But overall, we are starting to see that narrative and an early sign of a slowing US economy. And as a result, the markets are selling dollars in that environment. And this is why, some of us are in those GU longs, those euro dollar longs, all the way from those bottoms because we started to see that data turn. And that's us for timing to get in. Now, let's look at definitions. So employment. So what is employment? This is data that shows how the labor force and population are within that specific region, area, or of course country. Employment data shows how job creation is within the economy. The more job creation in an economy, the better growth is likely to be. Remember, if employment, begins to tick up, obviously that tends to mean more inflation, more spending. As a result, growth will get better, both from a GDP perspective, so from a holistic economic perspective, but also from a potential company perspective as well. Because if people are getting employed more, what does that tend to mean? Well, if they're employing more, their likely margins are pretty good. As a result, as people are employed more, to a certain extent, of course, there is going to become a threshold where too much employment is obviously bad because their margins get suppressed because of wages, etc. But overall, if people are getting employed, that's generally because the company is doing fairly well, which again all bleeds through into the inflation narrative, into the growth narrative. So what is the definition of growth? So growth data suggests If the economy is expanding or contracting, it's used to suggest how the economy is changing in its activity, productivity, and overall health. So essentially what I just said earlier about how look at the GDP figures for that overallistic growth within the economy also. But you can also look at how growth is doing within specific sectors. So how is the services growth? Is that good? How is manufacturing growth? PMIs will kind of give you that good idea about specific sectors within the economy. So both data, of course, work hand in hand. Think about the trend of the data, i.e., are we starting to see downside surprises in data? The markets will trade that idea for sure. Again, prime example, look at the US dollar in November 2023. We had that week NFP on the 3rd of this month. And since then, the data has kind of trended lower. The markets have sold the dollar off further. Now, let's just have a little look at some comparisons. So here are some examples of employment data. Again, they're going to be named slightly differently for certain economies. But you will get the gist of it the more you kind of just continue to keep up to date with it. Again, you can use that trade and economics, or you can use like Forex Factory just to see the news, the name. And then, of course, you can use whatever you want to, whatever you feel works for yourself, of course. There is no right or wrong answer. So, employment component of PMI. So, obviously, I mentioned that earlier, but I have made a video on that, just went in a little bit more depth about the employment component. But obviously, as we know, you have services and manufacturing PMIs. So, the PMI is basically a representation of that specific sector. So, like, what's orders like, what's employment like, what is prices like, etc. Again, there is an employment component. So how is the services sector, or how is the employment within services doing at the moment? Because we know that services make up a large amount of the economy for pretty much everybody in G10. And again, if we start to see the employment component of PMI within services PMIs especially begin to fall, that's an indication of weaker growth down the line, because we know that a large percentage of services makes up the economy, especially for the UK. So we know if there's a contraction in the employment component, that's going to equal weaker growth. Because again, there's less people employed, there's less spending. As a result, there's less growth. That's the thought process. Of course, unemployment rate. Unemployment rate gives us, it's in the name. How is the employment within the labor market? Is there a lot of unemployed people? And if there is, then there's increasing in unemployment rate. What does that mean exactly? Well, there's less people employed now, obviously. And as a result, does that mean good growth or bad growth? Obviously, a likelihood of bad growth down the line. Employment rate, of course, just another bit of data. Labor force participation rate. You might have seen this before. Just about basically what that means is the amount of people who's actively looking for work in the workplace. So as we know, if there's more people actively looking, that means more people likely being employed. As a result, better growth. Job openings. That's a US sort of centric data there, but it will be named slightly differently for specific economies. You can also look at the average hourly earnings. Most of the time, if you see average hourly earnings rise, that tends to mean slightly better growth, only because people will be getting paid more in their sort of employment, and they're likely to spend, and that tends to mean more growth. Employment to population ratio, again, just another bit of sort of spread you can look at for employment. There is a multitude of different examples of employment data. It's just these are just some examples. I'm not going to put the entire list because there's going to be a lot. Non-farm payrolls, of course, as we all know, NFP is very, very important for the US especially. Now, in terms of growth, here are some examples of growth data. So obviously, as we know, GDP, the holistic perspective of the economy. You do have some retail sales that does represent growth as well, because if there's less people spending, that tends to mean not exactly the greatest growth. Consumer sentiment surveys, they do have some growth perspectives in there. Economic growth rates, trade balances that can contribute to growth, by the way. There's better trade balance. That means likely companies are earning more, and as a result, better growth. Consumer debt levels. So obviously, if there's a high amount of debt, in the economy and debt levels, and that's rising, that tends to mean what? Not the greatest growth. And of course, government spending. What does the government do with their spending? Impacts massively how the growth is likely to be. For example, as I mentioned, we are recording this in November of 2023. We did just have this week, actually, the autumn statement from the UK and the Labour and of course the Conservative Party. They were, of course, cutting taxes. Everything they do within the government spending impacts growth massively. So I'm not going to go over, of course, everything that was said, because you can see that in the breakdown videos for that week. Now, employment data. So here's just an example of Europe Q3 to Q4. This is 2023, by the way. Q3 to Q4 2023. And of course, as I see here, stats are pulled from tradeandeconomics.com. It's a good website. Please use it more often. I know some people may not use it as often, but please, you do need to get used to using that website, because it's very, very crucial, because it's free for one, and it's got all the data you need. So what else could you ask for? So in terms of Europe, let's firstly have a look at the employment data. So wages. Think about the trend, remember. Always think about the trend of the data. Let's have a look. So wage growth, 4.6, previously 4.9. So this is the stat at the time I did the stats. 4.6, it came out as, previously it was 4.9. So it's trending lower. So that means less wages, which could be, or less wage growth, which then equates to less growth, because remember, if there's less people spending or less people earning as much, they're going to spend less. As a result, that's going to bleed through into, slightly less retail sales. That impacts GDP. So you can kind of see it all tells with each other. It's just a matter of not just, wages have fallen. Okay, move on. No, it's about wages have fallen. Okay, what does that mean exactly? What does this mean for employment? Or what does this mean for growth? What does this mean for inflation? What does this mean for the central bank? Have they spoke about wages being too high? If we're starting to see that fall, you're more likely to see a dovish central bank now. So these are just the thought processes you have. Again, it will come with time. You just have to stay consistent with it, basically. Employment change. So previously 0.5%. Now it came in at 0.1% on the employment change figure. Again, not the greatest. If there's less people being employed, or a percentage, that tends to mean, again, less spending, as a result, less growth. So overall, you need to have the basics nailed down. So you need to understand what GDP is. You need to understand the components of GDP. Again, we've made all of these videos. You need to obviously understand what inflation is. You need to understand what interest rates are, You also need to understand what the central bank is, etc. Once you understand the real basic stuff, all of the stuff we're looking at sort of in the videos now is just sprinkles on top, right? It's just adding to that flavor. It's about understanding now, watching this data impacts GDP, and now you can trade that theme, or all the data we're seeing impacts the main primary inflation rates. So it's all just adding to the narrative. So again, employment change previously was 0.5%, then came in at 0.1%. The employment component of PMI fell in Germany further, and job openings in Germany has fallen since July, which is not a great sign for growth at all. Now, in terms of growth data, so we've looked at just some examples of employment data. There's way more, but these are just some examples of just employment. Now, in terms of growth, let's look at the main figure, GDP quarter on quarter, previously 0.2%, coming in at negative 0.1%. Again, that means, well, if there's less growth, the employment data, the sort of wages, the retail sales, the sort of trade balances, that all adds to GDP, of course. You would have known GDP would have had to have fallen based on all of the data that you saw prior to that. So it's about understanding, one, what does this data mean? Obviously, you need to know what that data actually means. But then what does that mean going forward? What does this data impact this data over here? Or does it sort of cancel out this figure over here that we saw, etc. Again, as I mentioned, it will come with time. You just have to stay consistent with it. In terms of retail sales, so I looked at the German retail sales, but just because Germany, as some of us may know, does have the largest impact on the euro area data. So I just looked at Germany for this example, and previously it was 0%. It then came in at negative 1.2% on a month-over-month perspective, and the trend has been moving lower. That's the important perspective here. The trend is moving lower. Consumer confidence, again, only slightly got worse, but as I've mentioned here, it's been trending lower since August. So that's not a great sign there. And German business confidence has fallen since May, has slightly rebounded for October. So that's where we're at with that regard. And since basically then, this is what happened. So as you can see, I just got it from the August the 1st, the 1st of August 2023, and it's trended lower since then. And a large of this also was driven by, of course, what? You are trading this, remember, euro versus the dollar. So you're trading euro versus the dollar. So we had the European data that we just saw on the previous slide. All you got to do now is this perspective. How is the dollar doing with their data? And around this onward for the US was actually pointing higher in terms of data. And that actually was very, very positive for the US economy. Good for rates in the US. As we know, rates really, it's heavily impacts currency. So understand rates, you obviously understand the data, what that means for the Fed, etc. That was really good in the US. GDP was extremely good and upside surprising. And as a result, the market saw that as a very, very good limelight for the US. And that means lower because we know Europe and what we just saw, the data in Europe was pointing lower. And now we have the data in the US at the time was pointing higher. So why would you be looking for longs on euro dollar all the way trending lower? You are going to take unnecessary losses if you do that. And then you're going to end up blaming the market for all those losses when in reality, it's just you are trading the wrong side of the market because you didn't look at the fundamentals. So in regards to just a bit of a sort of little summary. Number one, remember, always think, if I see employment data start to fall, this will mean growth data is likely to fall in the future. And if it's been trending higher for some time and we start to see a bit of a turnaround, that's when you may start to see those peaks or the troughs in the market for those currencies there. So obviously if the US is, or if the data in general has just been pointing better, you would expect the currency to rally because rates would have moved higher in terms of yield. That would have been a bit more of a hawkish central bank. Naturally, a central bank is not going to turn dovish when their data is good. And as a result, that means better currency. And if you start to see it all turn around now, that's when you may need to start to get short tactically as a perspective. But as you know, I've made videos on those tactical plays, so please watch them in your own time. Your next thought process, so this is kind of a little bit of a thought. We've kind of spoken about this earlier. But your next thought process would be if growth is starting to fall, because you saw here that employment data is now starting to fall, that means likely growth is starting to fall. And if you are starting to see that data or this employment data start to bleed through into growth, your next thought process would be if growth is starting to fall, this will mean maybe inflation will likely fall. And as a result, potentially interest rates. Because again, it all tails with each other, right? Inflation, as long as there's no massive shocks, if growth is weak, inflation tends to move lower. If growth is good, inflation tends to move higher. Barring that we have no massive supply side issues or anything along the lines of external factors. But that's the thought process you'll have. And this will likely put down on the currency, removing everything else out the equation. As I mentioned, just forget about everything else, what is rates are doing, what's external factors doing, etc. If you just look at on the margin, if growth is falling, inflation will likely fall. Currency doesn't tend to perform too well when that happens, because that means, well, if inflation is falling, interest rates are likely to fall also. Remember to think about the direction of the data and what is the theme of the market now or at the moment. So what we mean by that is, are a lot of institutions talking about growth? Are they talking about inflation? Are they talking about another factor? So you've got to see what the theme of the market is and then see what data fits in with that theme. So we know at the moment in November 2023 is the market's theme at the moment is about the higher for longer theme. So basically what that means is the central bank's keeping rates higher for longer rather than continuing to sort of hike, and then aggressively cut. What they want to do is keep levels in a restrictive territory for longer rather than putting more strain on the economy by raising rates again. And again, that's the theme of the market. And that's largely being driven by growth. Because if growth is good, it means they can keep those rates high for longer. They're not going to cut rates when growth is good, because by them cutting rates means more inflation, means more growth. They don't obviously want more inflation. So that's what they mean by that high for longer theme. So that is the theme of the market, and we know growth is. So now what you think is, okay, what impacts growth? Employment, of course. So if we're starting to see employment, these are early signs of growth likely starting to fall. Again, it's not always one-to-one. Nothing in trading is one-to-one, but that's the thought process generally of the market. In terms of trading in this environment, you would rather be short the currencies whose economy is falling the most and has the most headaches. Ideally, you'd also want to be long the currency whose economy is strong, but this isn't always the case. This is when you need to find who has the edge over the other. So what we mean by that is, for example, next year, 2024, a lot of the economies would likely start to fall in terms of their growth, just because naturally they've risen rates so aggressively. That is going to come at the cost of something, which is growth, majority of the time. So what that means is, if the UK is weak in terms of their growth, and Europe's weak, and Australia is weak, and New Zealand's starting to weaken, and the US is weakened, you might be thinking, okay, how do I trade that environment? And this is what we mean by you have to think about the edge. For example, the UK might have a lot of political issues I don't know, let's say in April. I don't know. Could be whenever. But this is an example. You start to see a lot of political issues happen in the UK, and there's not much issues happening in Europe. You likely want to be long Euro GBP in that environment. Or if US has a lot of issues, let's say with, again, the political issues, because we know 2024 is also the elections for both the US and the UK, actually. You'll likely see a bit of volatility around the elections themselves. And then you think, okay, this generally, let's say, isn't bad for the US at that stage, or it is bad. You're going to likely be short the currency, short the dollar because it's bad in the near term, and be long sort of somebody who isn't as bad. Also think about sort of the channels of foreign exchange. So we know, I've made a video on that anyway, but what that means is there's 3 channels of currencies. So if you ever speak to sort of traders at banks, or, you know, once you, of course, jump onto Zooms and you ask them questions, they all talk about channels of currency. So we understand there's rates that drives currency, there's commodities, and there's equities. So equities meaning sort of risk on, risk off. Commodities obviously meaning what they export, are they benefiting off this, higher prices, etc. And of course, rates meaning interest rates and bond yields. And again, that generally is positive for the currency when yields are rising because it's more attractive. So you've got to find who has that edge. Maybe the yields in the US is falling extremely aggressively and the dollar's following the rates channel, whereas the UK's might have plateaued because inflation stalled. That's when you want to be long GBP USD. So you have to find who has the edge over the other. If you are seeing, let's say, strong versus strong, or weak versus weak in terms of their economic prospects and their data, that's when you have to find their edge. Generally, you want to be trading the clear-cut trades, UK really strong, Europe really weak, or US really strong, Australia really weak. That's when you see those big bouts of currency moves. But we know next year the theme is likely to be growth is now weak, who is slightly better. That's when you look at who has the edge over the other, whose growth is falling less aggressively, who has less political issues, who has higher oil prices. For example, that's going to benefit CAD and sort of put a downer on the euro because, of course, Europe imports a lot and a large majority of oil. So you might want to be short euro CAD in that environment. So these are just some examples, but I have made a video on the rates or the pillars of FX as they are known. But apart from that, a very, very simple video today. All you got to think really is employment's good. What does that tend to mean? That means more spending, more inflation, more growth. Fine, great. Okay, we're now seeing growth stronger. What does that tend to mean? More interest rates, because that if growth is good, inflation tends to be pretty high as well, or at least decent. And as a result, the central bank might be a bit more hawkish. The currency strengthens. Or on the flip side, think about the opposite side to that as well. If you're seeing employment fall, you like to see growth fall as well. As a result, that means probably less inflation. And rates will start to fall and the currency will likely weaken also with it. So a very simple video today, and I will see you on the next one. Take care.